Okay, so I do hope that you had a good experience while visiting the booths. If at all something is missed, I'm sure right after this session you can still visit the booths and fill out those feedback forms and experience anything that's still left to be explored. It's time. Having said that, for the keynote, that's the closing keynote. The future of finance is what we lay our focus on. Now, the CFO role shifting towards the Chief Strategy Officer, CFO role in managing the increasing risk as we talk about the CFO's responsibility to be the authentic voice of the ESG, the importance of digital transformation to support the three key trends that I just said. So, all right, allow me to rope in with some good round of applauses. Suzy Taherian, the CFO, Wrightspeed Adjunct Professor, UC Davis graduate, School of Management contributor, Forbes.com. Here's to you, our next speaker.
Hello, good afternoon. My name is Suzy Taherian, and I'm pleased to be joining you virtually today. I am the CFO of Expansive, which is an online digital exchange for ESG inclusive commodities. I'm also on the board of Wrightspeed, which is an electric vehicle company making buses and trucks that have zero or low emissions. I'm delighted to talk to you today about the future of finance, and I hope that you can see a few slides that I'm going to share on the subject with you. The topic today is future of finance, and we're trying to understand as the future finance leaders, what are some of the things that and trends that we should watch out for and prepare for. And I want to focus on three trends today. One is more strategy, the other is more risk, and the other is more ESG. And we'll talk about how these impact the CFOs and also how data and analytics and the tools that CFOs have really position us well to respond to these three major trends. On more strategy, just to highlight what that means, there was a survey that Grant Thornton did of CFOs recently in May 2020, and 42% of the CFOs said they spend as much as half their time in a strategist role. We'll talk about what that means. It's taking more of a strategic role for CFOs. And then on more risk, I've included a quote for you from a Federal Reserve governor in US that talks about vulnerabilities associated with elevated risk appetite. And talking about stock prices being high relative to earnings, and the appetite for risk has increased broadly as meme stock episodes demonstrate. And we'll talk about some of the trends in US particularly, but globally also, where there is a heightened interest in pursuit of risk with the hope that it would result in higher yields and returns. And so we'll talk about what that more risk environment looks like and what that means for CFOs and finance leaders. And thirdly, we're going to talk about ESG. ESG stands for Environmental Social Governance Trends. And this is a global trend as many countries in the world and leaders in the world are recognizing the dangers of climate change and looking at ways to address that, as well as more trends towards social and governance and inclusivity and diversity. And this is showing up in a variety of ways. One example I gave here is the European Union launched a €1 trillion Green Deal to invest in environmental initiatives with the goal of achieving carbon neutral Europe by 2050. And we'll talk about what this means for CFOs. And then, of course, underlying all this and supporting all these trends is data revolution and how CFOs can leverage that to be more successful on these three trends. First, on the strategy, more strategy, and CFOs as chief strategy officers. Really, our role has changed from being chief accounting officers and closing the books and looking backwards to looking ahead, developing strategy, and being more a chief strategy officer. There's data I found that showed that 29% of CEOs hired post-pandemic in US were formerly CFOs, recognizing that CFOs now have a stronger suite of skills on strategy, which positions them well for being CEOs. And there's a lot of stuff that we do as CFOs that really dovetails into the strategy role. One example I use a lot is the budget versus actual exercise. All of us in the finance world do budget versus actual variance analysis. But we can elevate that from just a purely accounting exercise to a forecasting tool to understand not just what happened last month and why revenue or expenses were higher or lower than expected, but what that means for the future month. Was revenue lower this month because it was shifted to a future month and actually we'll see higher revenues in the future? Or is revenue lower this month because we lost a key customer and we should expect to see that trend continue? And most importantly, what we should do to combat that trend and bring the plans back on track. So using that budget versus actual exercise that we all CFOs have as a forecasting tool and to generate a conversation around what is our strategy going forward, how are we performing against that today, and what do we need to do to continue to stay on track or get ahead of the plan. I actually recently co-wrote a book on this topic called 82 and 20 CFO, How to Make Strategic Transformations in Your Company. The goal of the book was to help new CFOs and new finance leaders understand how they could be a force for strategic transformation. And the reason we wrote the book is because we heard very frequently from a variety of CEOs, board members, investors, that their current CFO, while very strong in accounting and high integrity, really did not have a strategic perspective, and that was missing. So this book was hopefully helpful to some folks to understand how they could play a more strategic role. So that's the first trend we talk about is more strategy and how finance leaders can weigh in there. The second trend we're going to talk about is more risk. I like to tell a story. There's a joke that private equity folks like to say. There's a private equity guy who was working 12, 20 hours a day and decides to take a vacation, and he stays at a small seaside village and likes to go down in the mornings and say hello to the fishermen who are out there fishing. And he becomes friends with the fishermen and notices this guy shows up at 8, fishes till about noon, and then goes home. So the banker talks to the guy and says, what's your story? And the guy says, well, I make enough money from 9 to noon to feed my family, and then I can take the rest of the time and enjoy my family and relax and hang out in the tavern with my local friends. And the investment banker says, yeah, but you know, if you work 12 hours a day, you could save some money, buy some more boats, start a company, hire a bunch of people. Then pretty soon you could have 100 boats. You could do initial public offering, go public, and have $1 billion enterprise, have ships all over the seas, and be a very, very successful guy. And the fisherman says, yeah, and then what would I do? And then the investment banker says, well, then you could retire somewhere by a seaside village and just fish for fun from 9 to noon and spend the rest of the time with your family. And this sounds like a joke, but it is an interesting phenomenon because it shows how the private equity industry and the venture capital industry has transformed how business is done, where in the past we used to have small family operations like the fishermen taking very real risk, working from 9 to noon. Now we're driving those towards being large conglomerates, growing much more rapidly and taking on more risk. And that's a bit of a joke, but I actually had this experience in real life. There's a shoe designer near me in my little town, an Italian shoe designer, and I love buying his shoes. He's got a little tiny shop, and I went in one day and I said, you have really beautiful shoes. You should put these on the web and get, you can sell these all around the world instead of this one little store. And he said to me, well, yeah, and I talked to Amazon and to Nordstrom, which is a very large retail chain in the US, and they would want to order $1 million of shoes each. And I said, well, that's great. He said, yeah, but then I have to take out a loan and payment terms. I need to hire a lawyer and an accountant. And he said, I just like designing shoes, so I'm just going to bypass that. So I realized that I had inadvertently been doing the same thing as the joke was, where I was encouraging and advising this business owner to grow his business and take on more debt and perhaps more leverage and more risk, but to grow the business and be more financially successful potentially. This trend has been not just me and the investment banker and the joke, but it's been going on globally. In May, you may have heard David Swenson, who was the head of the Yale Endowment for 20 plus years, passed away. And he was a transformative figure because he was one of the first people that started investing endowment money in things other than stocks and bonds. When he started in 1980s, they had 25% of the endowment in stocks and, 75% in stocks and bonds and 25% in alternative investments. Today, fast forward, they have 75% of their investments in what's called alternative investments. This is money that's invested with hedge funds, private equity firms, venture capital firms. As you can see in the graph on the right, they went from having $1 billion in assets to over $40 billion in assets. So this more risky strategy of investing with private equity and venture capitalists had significant returns and really grew the endowment. This model was copied by other endowments and by other pension funds and other institutional investors, and it's become now the norm in the investment environment. What that meant is all these different investment organizations have been investing in private equity and venture capital firms that have really taken off and become giant industries. And as you can see from the graph on the right, in these kind of industries, the returns they look for are 15 to 50% per year return. So that is driving these investors to push companies to take on more leverage, grow more quickly, enter into emerging markets or new products, or take on additional customers and additional risk. So in the pursuit of that additional yield, they are perhaps pursuing additional risk as well. And this is what's bringing us to it's a riskier world. And even if the company you're working with is not private equity backed or venture capital backed or looking for these kind of returns, it's competing with other companies that are, which means it's driven to take riskier positions so it can stay competitive with them. And that is going to drive a whole set of behaviors. And as CFOs and finance leaders, that's something you have to be aware of, that the demand is for higher returns, which means we're taking higher risk, and how do we mitigate those risks? The third trend that is important to talk about is the trend towards ESG, environmental social governance. And this metric has become as important as earnings per share for us CFOs. You will see a lot of conversations today, not just from nonprofits or non-governmental organizations, or not just from impact investors, but really from large financial institutions and major investors. The World Economic Forum and the International Business Council, which is run by a CEO of Bank of America, obviously a very important financial institution, partnered with the big four accounting firms, Pricewaterhouse, Ernst & Young, KPMG, and to come up with what they called a framework for 21 ESG standards. And the idea is that they would make this a standard just like GAAP accounting or IFRS accounting. So financial leaders would report on the environmental social governance metrics just like they do on the revenues or earnings. Today, most large companies have something called sustainability report, where they talk about their environmental activities or their social governance activities. What this trend is talking about is making that mandatory standardized reporting, which would be something that CFOs would have to be responsible for. The other interesting trend we're seeing is a lot of large institutional investors pushing for ESG. BlackRock, which is the largest asset management in the world, I think with about 9 trillion of assets under management. They've made statements that says they expect companies to meet ESG standards. Same thing with the Norwegian Sovereign Wealth Fund. Norwegian Sovereign Wealth Fund is the world's largest sovereign wealth fund with $1 trillion of assets. Ironically, the Norwegians made their income from oil and gas, but invested in sovereign wealth fund. And they came out a few years ago and said that they will no longer invest in any fossil fuel companies, and they are very much pro ESG. So this is just two examples of very large financial investors that are putting their weight and power behind ESG metrics. There was just last week, there was sort of a trifecta in oil industry. Shell got a mandate from European Union to reduce its emissions by 45% in the next 9 years, which is a very strong mandate. Exxon got a mandate from its shareholders to put 2 board members that were more ESG focused on its board, and Chevron did the same. So there's a very loud and clear message from investors and shareholders and financial stakeholders that they want companies to focus on ESG. And this is also something that CFOs will have to be active on. So the good news is that CFOs are very well positioned to respond to these three trends because we have always been very much focused on data and analytics, and we have the tools to respond to these three trends. Data is a key tool to drive strategy. We have often been involved in developing the business plans, and the business plan is really just a financial way representation of the strategy. And by using data in analysis, CFOs can be very helpful in taking a sort of philosophical strategy into a quantitative numbers that the organization can align around. And CFOs, of course, have always managed risk. That's been a big part of our responsibility. And data is a great way to do that. We can quantify the risks, whether it's foreign exchange risk, whether it's property risk or other insurance, and how do we mitigate that. So the data is there to quantify the risk. The data is there to benchmark versus comparable companies in the industry to see what mitigation measures they take. One tip that I give new CFOs in US is I work with an insurance broker called Heffernan. Jan Berthard and I co-wrote the book on CFO, 80/20 CFO. And one of the things I like to do is have Jan and her team from Heffernan Insurance come in and do a risk assessment for me whenever I'm at a new company. And they do a fantastic job of quantifying the risk, looking at all of our risk, understanding what it is with interviewing people. And then they also look at comparable companies. What is their property insurance risk? What's their director's office's insurance? What premiums are they paying? What deductibles are they seeing? What kind of coverage are they getting? And then with that benchmarking and data, I can propose to our board what is a good risk mitigation strategy. So that data helps me be very effective in managing risk. And then the third one is ESG results. Obviously, CFOs have often been the keeper of the books to represent other metrics that are important to the company. And if ESG becomes important metrics as well, we can do that. And CFOs have always been the conscience of a company and have always been very important in their role as, in integrity of all numbers and data that they represent. So they will be able to speak well and convincingly on ESG matters as well. And just to round out on how the data piece plays into this, we're seeing more and more data, and this is showing up in all kinds of ways. The digitalization and means there's more data collected, there's more data transmitted, there's more data analyzed. And just one data point that I thought I'd share with you is annual semiconductor sales, which shows the growth in semiconductor chips, because as we collect more data, we need more semiconductor chips to collect the data and also transmit it. And interestingly, this past year, we saw there was a big shortage of semiconductor chips, and CEO of Intel expected it to last for more than 2 years per Wall Street Journal. And it's interesting because the reason there's a chip shortage is because there's chips in automobiles, there's chips in a variety of tools and equipment, because we are collecting that data, and also because we want the capability to transmit that data on our phone or our laptop or iPad. So this is causing the chip shortage, but it also highlights the point of the importance of data and the continuing trends to digitalization. That's not going to go away. And hopefully we'll see the chip shortage resolve itself. And this is an opportunity again for CFOs to invest in digitalization, to be able to get more data and analytics, to respond better to the need for more strategy, more risk, and more ESG. Thank you for your time. I really appreciated being with you today.
Thank you, Suzy, for that final important address of the day. Folks, don't go anywhere away, because we do have one more content delicacy planned for you. While, of course, our speakers did render their respective addresses and there was so much to learn, I would definitely let all of you know here that a roundtable is also being scheduled from 3 to 4 p.m. today. Yes, right, in some bit. So this is going to focus on the future-proofing businesses with new age technologies, a CFO story. This is powered by AWS. So those of you who are interested, you're most welcome to join. On that note, yes, we assimilated how in reaction to these unprecedented times, the CFOs must play, and they are playing, a critical role in reshaping their organizations, keeping in mind the growth of the business value and the know-how of the digital digital tools and technologies at the same time. Yes, we did identify the problems, the solutions, the challenges, and also built a roadmap, especially with the last session that we just witnessed, to become more data-driven. Well, on that note, it's time for me to give a happy shout out to our presenting partner, Dell Technologies, our platinum partners, Tata Communication, NetApp, Hitachi Systems Microclinic and Commvault, IBM, Hitachi, Vantara, and Logitech. Our gold partners being Juniper Networks, Exclusive Networks, Tenable, Zoom, Amazon Internet Services, Automation Anywhere, and Redington. Our associate partners being Cloud Era, More Engage, and Samsung STS. Our supporting association, thank you so much, Data Security Council of India. Our media partners being Analytics Insight and Silicon India. Well, with that, just in case if any of the partner booths are still left to be explored at the experience zone, please don't miss on it. Please do visit them and make sure that you fill in the feedback form, the tab that you see at the bottom of your screen. So please click on that icon that's right here. And also one is at the different exhibits that you see. So that gets you some good points and some real good Amazon gift vouchers worth up to INR 5,000. So that should get some happy cheer, right? So before I sign off from the FinCon Day at the ETDataCon Virtual Summit, ladies and gents, I have to say thank you to you because, you know, the show happens because you're there, right? So let's give a big hand for your good virtual presence with all your energies, attention intact. Yes, I'm going to be inviting all of you to join me tomorrow sharp by 9 a.m. for the third and the final big day, the Marcon Day, as we say it. And of course, for the scintillating afternoon of glory that awaits us, for the afternoon of tomorrow for the ET Most Promising Tech Marketers Awards 2021. Yes, it's going to be a big day. I'm going to be saying ciao for now. Thank you for joining us.